Hey everyone, Doug Smaldino. Hope you're doing well. Hey, I got a really great product I want to share with everyone tonight. It's something that's just perfect, I think, for this market. Before we get into it, I didn't really want to talk too much like I normally do about what's going on in the financial markets. You know, they're doing great. They're basically doing everything I expected them to do, and I've been saying real quick, stock market is well above its 50-day moving average here, as you can see, and it's building some what we call consolidation lately in this little base it's building here, which is good, but nothing too exciting. It's been a little not as the volatility has dropped down a lot, which is good. So that's it with that. Mortgage rates, pretty much the same thing, hanging in there, pretty stable. Like I said, guys, the days of we're not going to hit no 7 or 8 or 9%, okay? So you lose the fear. By the way, the stock market year to date is only down 11% from its, let me see if I have that on the last chart. I do not. Okay, I do not. I got some advertising here, which is interesting, but I do not. But it's about 11%, the Dow Jones Industrial. So things are coming back, guys. Things are stabilizing. Overall, the market's doing great. But today I want to talk to you about a product that is, believe it or not, this thing's a dinosaur. It goes back to the 80s and 90s when it was really popular. It's been around ever since then, but nobody's got it or nobody's offering it. We have it. We have, just to give you an idea, it's going to be very difficult to find this product, but we have it. Out of 140 investors and lenders that we work with, only 2 are offering it. Now, luckily, we work with both those 2 all the time, and this product is amazing. I think just absolutely what the doctor ordered for this market, and I'll tell you why in a second. But first thing, let me show you an example. This loan is called a Buydown loan. Okay, there's 3 types of buydowns. I'll just going to go over the 2-1 Buydown. It's the most popular. Sorry, a little sip of my Diet Coke here. It's an amazing program. Basically, what it is, it's a 30-year fixed rate loan. Okay? In the first 2 years of the loan, the rate is less, so you pay less. Now, guys, I know we saw this big run-up in mortgage rates. Remember, as you guys know, as the mortgage-backed security price drops, mortgage rates go up. So, you can see that we've had this deep decline. This is year to date, and this has caused rates to go up. I get it, but now we're stabilizing, and I could almost guarantee you we're going to see lower rates in the next 2 years. Okay, so every loan that has been done this year in 2022 so far is going to be refinanced at some point. It's going to be crazy, to handle that much volume when it happens, but this is just the way it works. The mortgage rates should not be this high, and that's why they've come down. They should come down. They never should have been this high. So the 10% mortgage rate, the doom and gloomers, the 9s, the 8s, the 10s, it ain't going to happen. They've done what they're going to do. And like I've been saying, they had their little hurrah. Got the little thing in July or June with the inflation report. It just freaked out the market. Just listen to the guru, okay? I got this. You guys, we got this. All right, now let's figure this out. Let's be smart about this and figure out how we're going to use this to our advantage to make some real good investments here and push our financial situation much better. Now, this Buydown loan, a 2-1 Buydown. So let's say that the 30-year fixed rate today is 5.5. It's a little lower, but just say it's 5.5, okay? Basically, in the first year, you would pay an interest rate at 3.5%, 2-1 Buydown, 2% in year 1, 1% in year 2. So 2-1, in the first 12 months, you're going to pay at 3.5%. The second 12 months, you're going to pay at 4.5%. And then the third year, it goes to the 5.5% and stays at the 5.5% for the life of the loan if you kept it the entire 30 years, which I doubt. But let's look at this a little closer. Take a look at it. I got a little calculator here. So let's do an example so you understand here, because there are just a couple of nuances to be aware of. So if we take like an $250,000 loan, and let's say the interest rate is the 5.5, and it's a 30-year loan. That's 360 months, and we're going to get a buy down of 2% in the first 12 months, and a buy down of 1% in the second 12 months. All right, so here's what it's going to look like. Let's click the little. All right, here we go. So here's the total payment. This is the payment that would be on the $850,000 at 5.5% is $48.26.21. Okay. However, the buyer pays at the lower rate. See the 2% buy down for the first 12 months. So the payment is only $38.16. So you save $1,009 a month for the first 12 months. Then in the second year, the interest rate goes to, instead of 5.5, it's not 3.5. It goes to up to 4.5 because it's 1%, not 2%. So in the second year, again, the payment on the 5.5% is the $48.26.21, but you only pay $43.06.83, and that's $519.38 savings. Okay, so over the 2 years, the amount saved is let me bring it up a little bit here, $18,344.52. Now you can see that in the third year there is no buy down payment because you're at the full amount at that time. But here's what has to happen. The sellers are getting a little nervous right now, okay? So I think you got a window of opportunity from now in the next 6 months to go to make an offer on a property. Let's say you find a property for $1 million and say, okay, Mr. Seller, I'll pay you $1 million for the property, but I want you to pay $18,000, let's just call it $20,000 towards my buy down fee. So the seller is going to say, basically the seller's getting the $980 for the property. What happens is that the buy down money sits in an escrow account with the lender. So the lender isn't paying the buy down fee. It's a 30-year fixed rate loan. The buyer can't pay it. The lender's not going to pay it, so the seller pays it, okay? Now, of course, we can get creative and increase the purchase price for the buy down fee and all that, but for all intents and purposes, what happens is that money goes into the escrow account, and then every month the lender would receive, like if it's here, the first payment, the lender would receive $38.16.88 from you, the borrower, and then take $1,009.33 out of the escrow account, thereby getting their $48.26.21. Okay, so the lender is not doing you any favors with this buy down thing. It's just a way for you to keep a lower payment during the first 2 years of the loan. Now, people have talked about this so far. This is like catnip. They're all over it. They're saying, well, wow, this is amazing, because everyone wants to ease into a payment. But here's the other mastery of the thing is that, like I've been telling people, like we talked about these rates, right? These mortgage rates are way too high. You know, even though they've come down, they're still too high. They're going to drop, and you're going to want to refinance. So what happens here if you refinance at the end of the first year? Just say what happens. Well, the money sitting in the lender's escrow account for the buy down fee, what they do is they just pay down your mortgage. It's your money. You get the full benefit of it. So that $6,000 that's sitting in this escrow account would go to reduce your mortgage balance. The lender doesn't get it. The seller doesn't get it back. You get it in the form of a principal reduction on your mortgage. And this is the reason I love this loan. The reason I'm just like head over heels in love with this loan is because, of course, I'm the only guy that's got it, which is a great thing. But also the fact that you get it, you're going to refinance the loan within 2 years, most likely. Like I'm positive. So let's pay the lowest possible amount of interest as we can, and if we refinance to go from a 5.5 rate to a 4.25 rate or 4%, better yet, you've basically paid that in the first 2 years. You paid 3.5% in the first year, 4.5%. So your effective rate is 4%. So you win all the way around. This is a great program. That extra $1,000 savings in the first year and the $500 savings in the second year is fantastic. So this is a great thing. Now, I did this, ironically, this email came across my desk today from Mortgage Professional magazine, and it says right here, is this the saving grace amid rising mortgage rates? By the way, there's a link to it in the comments before to this article. I highly recommend you read it. It says one option is making a comeback, and what do you think that is? The 2-1 buy-down loan, the one we're talking about, okay? It says, you know, rising rates have emerged as the boogeyman of inflation, hitting homeowners in the pocketbook, where impact is felt more accurately. Against this backdrop, temporary interest rate buy-downs are making a comeback. Okay, it's not exactly right. Technically, it's not the inflation that's causing the higher mortgage rates, but let's go with it. They are making a comeback, but the problem is that, like I said, there's no lenders that are offering it right now because it's such a dinosaur. It hasn't been offered since the 90s. Okay, now, temporary interest buy-downs, particularly the 2-1 buy-downs, are increasingly being seen as a haven for lower interest rates. I love the fact because it's going to bridge the gap between now and when you refinance. You're getting basically the benefit of the refinance now through the buy-down. The most popular is the 2-1 iteration. There's a couple different versions to it. This is the most popular. How does it work? The seller basically puts a certain amount. We already went over this. I'll read it. The seller basically puts a certain amount of money that's based on the lender requirements. That's the buy-down fee, the $18,000 that we had in our example. Essentially, what their value those payments at into an escrow account. Then the borrower basically pays a monthly payment over the first 2 years of the loan that's reduced. So the seller's basically paying it. You could read this on your own. Basically, it's a great opportunity to keep your payments down the first 2 years and capitalize on the refinance. Now, if I'm totally wrong, and the rates don't drop, then you're still fixed at the 5.5. It will never go higher than that because it is a fixed rate loan. So take a look at this. Let me know your thoughts. If you have any questions, you want to run some scenarios, let me know. This is a great way to get in the market right now and take advantage of it. I'm always here for you. Just hit me up with an email, wherever's or give me a call, and we'll be happy to help. All right? Have a great rest of your day, everyone. Cheers.